What can we do to create a more worry-free retirement for people planning now and moving into retirement?
Yeah, worry-free retirement is a big deal. We all want that, but how many of us are going to have that? And if you look at that traditional financial advice, most people, Steve, are planning on Social Security and then whatever money they have in their 401k or IRA. And when you're going into retirement with a volatile plan, a volatile system, there is a lot of worrying that comes with that. So, how do you get a worry free retirement? Number one, it starts with guarantees. Look at your portfolio. What do you have in your portfolio that is guaranteed? Most people are going to say nothing, except maybe I've got some cash in the bank, it's in my savings account earning 1% interest. So, guarantees are crucial because when you get into retirement, you don't want your money in the market subject to losses. That's the last thing you want. The idea in retirement is principal protection. Protect the money that you've made. And look, if you're 30 or 40 now, there are things that you can do to plan 20 to 30 years out to have guarantees. What I love is this is supported by third party people and third party organizations. For example, Ernst and Young, Dr. Wade Pfau. These groups and individuals have looked at what creates worry free retirement. And there are two primary things, and it's probably going to be surprising to a lot of people listening. Number one, cash value whole life insurance. And some of you might be thinking, what? Why do I want cash value whole life insurance in my retirement plan? Why is Ernst and Young recommending that? And two are annuities. Annuities that are guaranteed to provide, check this out, guaranteed lifetime income that you can't outlive. And what Ernst and Young talks about, what Dr. Wade Pfau talks about, and many others, when you combine these two assets together, you have the guarantees, you have the liquidity, and the good majority of that income now comes to you tax free. So we're going to get into some of those details, but those are the two primary things that are providing a worry free retirement. Most of you, you've never heard of this before. You're getting advice from traditional financial advisors in Wall Street. Keep your money in the market, buy the mutual funds, buy the ETFs, get the stock portfolio. Well, the problem with that is it's all uncertain. You don't know what you're going to have in retirement, which can cause the worry. We want to help you with worry free retirement. This is not just our opinion, it's being backed up by major players in the financial industry.
So Barry, let's unpack that for a second. So you talk about guarantees, and somebody listening might not know exactly what you're getting at. When you look at guarantees, you're looking at some contractual, which I like contracts as an estate attorney. You're looking at contractual certainty, right? You're bringing in a portion of your retirement and wrapping that in some contractual certainty. Number one, cash value overfunded life insurance is one contract. Annuity contracts are contracts, and they all allow you to take the guessing game out of a portion of your retirement, which is huge, right? For helping folks not have the uncertainty that goes along with what really are speculative investments.
I'm going to get into those. I want to share an analogy. It's a silly analogy. Some of you have probably heard it. But what if you're getting on a plane and right as you're walking into the plane door, the pilot or stewardess says, "Hey, we have about an 80% chance today of arriving at our destination." You would go, "What do you mean?" "Well, we had some little engine trouble earlier and we're not sure that the landing gear is going to fully deploy. But look, it's okay. It's okay. We're 80% certain that we'll be able to land the plane. You're not going to get on the plane. Imagine that same idea, that same example, going into retirement. But Steve, here's the problem. It's worse than 80%. So if you're planning for your future and you want more certainty, you want more predictability, 80% shouldn't be sufficient. 60% is terrible, and 50 or 40% you just don't want to go near. But that's what most people are doing. So the guarantees provide someone to say, look, I know, and this is one of the benefits. I know there is a certain portion of my retirement income that will be coming to me that is 100% guaranteed, not 50, not 60, not 80, 100% guaranteed. How is that going to work for someone in retirement knowing, look, I can't outlive this money? I have a contractual guarantee with a solid insurance company that will provide me a 100% guarantee on this particular amount of money. That's pretty phenomenal.
Pretty phenomenal. And you think about increasing life expectancies and all those advancements contributing to people's concerns that they could run out of money.
Yeah. What Ernst and Young, Dr. Wade Pfau, and others have discovered is that when you couple whole life insurance that gives you a permanent guaranteed death benefit and cash value growth with an annuity, what happens is not only are the guarantees there and the liquidity and some tax free money, but if you are taking annuity income, we call this like a self funded pension. Everyone would love to have a pension, right? You work, your company's going to pay you a pension for the rest of your life. An annuity is a self funded pension. And what happens is if you can take the maximum income from that annuity and you pass away, say you've used a bunch of money from the annuity, you pass away, now you also have that permanent life insurance death benefit that's going to go to your beneficiaries. Well, what if you want to spend and enjoy more of your money? Maybe you take out more of the annuity. Maybe you begin taking more tax-free income from the life insurance policy. See, the whole life policy is a buffer. It acts as a safety net that if you do have some market based money too, which a lot of people are going to have, we recommend the market based money with the annuity, with the whole life insurance. And now that whole life policy acts as a safety net. Because what if you are taking like required minimum distributions? You're forced at the age of 73, you must take money out of your qualified plans, whether you need it or not. You're
Yep.
forced to do it. And if you don't, you get hit with penalties. Well, let's say you're taking the RMDs and maybe even more because you need more than that, perhaps for the lifestyle you want. What if that portfolio goes negative? What if in the year that you're ready to start taking income, the portfolio is down 20%? It would make no financial sense to take money out of that negative account for income if you had another option. The problem is, Steve, a lot of people don't have another option. So they're taking money out of a negative account, which is adding like insult to injury, right? You've got, oh my gosh, I'm down 20% and I need money for income. I'm harming myself two times. But if you have the whole life policy, take cash value from that policy. And because it's tax free, you don't have to take as much. You can take like 30% less. Don't take money from the market account at that point. Got to take your RMDs, but don't take the extra. Let the market recover. Use the whole life policy as a safety net. We call it a buffer. And then right in the middle of that, what if you also had an annuity? Let's say you shifted and rolled over a 401k or an IRA, some portion of that, to a guaranteed income annuity. That money coming right to you every month, every year. There's your guaranteed portion. Now you can play with the market money and the whole life tax-free cash value for the other income that you need.
Yeah, what a terrific example. So you're addressing that, what we call sequence of returns risk by having a couple of different flexible buckets, the annuity and the cash value whole life tax-free bucket to offset that market risk, which is fantastic.
Steve, I've said this before. I'm going to say it again. I want people listening to really have this in their brain, in the forefront of their minds. If you look at what Dr. Wade Pfau, Ernst Young, and others that have done these studies, they've looked at tens of thousands of examples, right? They're not messing around. And what they have discovered is that when you couple annuities, cash value whole life with your market-based investments, the person doing that the right way will end up with 30 to 50% more spendable income. Who doesn't want that? So for those of you listening, we have a way. We can show you how to have 30 to 50% more spendable income in retirement. If that's something you want, we should have a conversation. I don't know anybody that doesn't want that, along with guarantees, tax-free use of money. There's many other benefits we're not even touching on today, but there you go, 30 to 50% more spendable income.
More retirement income plus the volatility buffer that we just talked about. And there'll be a link wherever you're watching. And I encourage you to look at how this can work for you and really shore up your retirement. Not only reduce volatility, but also to boost income, which is awesome. So thank you for sharing, and I appreciate you guys joining us today, and we'll see you in the next one.